Good afternoon, ladies and gentlemen. With me on the stage, he needs no introduction. He's on Sky News most days, CNBC, Wilfred Frost. Sure all of you know of him. But before we start, we regard this master investor as being a bit of a family, and I see people here every year coming back and back and back. But the longest, most devoted attendee of the master investor was this man here, David Thurston, who unfortunately passed away a few weeks ago. And I wanted to pay tribute to him. He died at the age of 80, but he'd had Parkinson's for 30 years, so it's very impressive that he managed to stay the course for so long. So just a brief tribute before we get into what we're going to talk about to David. And his friend Neil Farron, who brought him here every year in the latter part of his life, is also here today. And there he is, and took this photograph. So thank you very much, David, and Neil.
Well, indeed. And as you said, Jim, it's a family, this gathering, a massive one, and a great turnout. And to start to say our thanks to you for starting it all and for chairing it. It's a thrill to be here, and to dive into some of the investment topics that everyone here wants to get your take on. So I think you've got the slide thing there. Talk me why this is your first picture.
Well, I assume most people here know of the TV series Curb Your Enthusiasm. And I think that's what those who have been caught up in the Magnificent Seven in particular, need to do. You may have seen yesterday, I'm sure you did, Wilf, that NVIDIA, which is the darling poster child of the Magnificent Seven, and actually the only one that still has big momentum behind it, since Tesla and Apple have kind of fallen by the wayside, had a round trip yesterday, and I think it ended up down 6 or 7%. Personally, I think we're at the peak bubble at the moment, and I think it was marked by the fact that, first of all, I never bought any NVIDIA, so shows what a lousy investor I am, I guess. But also I bumped into Jensen Huang, who was the founder, the leather-jacketed fellow who started NVIDIA. They're making their products for between $900 and $300, and they're selling them for $50,000 to $100,000. And we know that in the semiconductor business, capital intensive, lots of innovation, lots of changes of use. That's a model that can't persist. So the idea that that company is worth $2 trillion, one of the 3 most valuable companies on the planet, to me, is absolutely nuts. So curb your enthusiasm.
So let's give a bit of detailed context on what you're alluding to here, which is that the US markets have been the envy of the world, but really only in the last 6 months or so because of 5 or 6 stocks. It's not even the full Magnificent Seven. So is it fair to say from what you're saying there that you're as bearish as you've been for a while on the S&P 500 as a whole?
Yeah, I think there's great opportunities in markets around the world, which we'll be mutually talking about. And there's plenty of places to put your money. But the US, not exclusively, because obviously there are some good companies in the US, particularly smaller cap companies that, as here, have been somewhat ignored. And one of the things that I'm most worried about, Wilf, is that this move to index funds, to passive funds, has been quite dramatic. We've got a slide on this later on. And that, in a way, is potentially the death of the market, because every time NVIDIA goes up or Microsoft goes up, the index funds, which are getting the bulk of new money into them at the moment, because they're sort of easy and they're cheap and so forth, are obliged to buy more of the same stocks that are going up. So they're kind of self-reinforcing until the music stops. Mm-hmm. And we may be at the point where the music stops because the US has been riding on a sea of liquidity, money printing, Inflation Reduction Act, and as you will, I'm sure, allude to, the fiscal situation in the United States is basically out of control. They are going to have to rein that in one way or another, which is why you'll see interest rates, and here's a sort of prediction on interest rates, will stay higher for longer. There won't be these massive cuts that people are expecting. So, yeah, at the moment you're playing a pass-the-parcel game with Bitcoin, NVIDIA, Microsoft, and so forth. You don't need to do that. There's plenty of other great opportunities out there.
So I just want to push back on that a little bit because, as you said, you didn't buy any NVIDIA.
No.
And the arguments in general against why this can't go on applied a year ago. They applied even 2 years ago. So what did you miss that allowed NVIDIA not just to go up another 10 or 15%, but double since the start of last year? And also, why has higher rates, which clearly we're now in and have been for a couple of years now, not hurt equity market valuations multiples in the US?
Because the rates aren't really that high. They're just normal rates. And because rate rises take a long time to filter through to the real economy. But I think I missed out on it because I just wasn't adroit enough or intelligent enough. And also, I never liked to buy things at ridiculous P ratios and very elevated valuations. So my whole investment career has not been focused on buying stuff at, silly valuations. So it just could be that I'm like an old buffer who's just not recognized that the world has changed. But I will bet you that this time next year, we'll be talking about something else. It certainly won't be NVIDIA, and it won't be the stocks that have become so familiar. And I want to point out that when the dot-com bubble burst at the end of, the beginning of 2000, the turn of the century, companies like Amazon went down by 95%. There was no change to Amazon. It was still a very fast-growing company, and it's obviously done extremely well since then. But you would have suffered a massive hit to your wealth had you invested in Cisco, Amazon, Microsoft, all those companies which had monumental falls. And we could be setting ourselves up for another monumental fall. It doesn't mean that these companies aren't good companies. It just means like the Nifty 50 in the 70s and in the year 2000, when the Ciscos and so forth were so highly valued, that they were wrongly priced. And it took decades for them to get back to the price catching up with their growth rates.
So the quick pushback to that from the bulls on Wall Street, and particularly the tech analysts that always have buy recommendations, would be say the equivalent for AI as the driver today is the internet, but in 1995, not 1999. Do you think that's possible, that there's a little bit of a pullback to come, but Microsoft then still had 3 or 4 great years before the bigger crash in the turn of the century?
Well, it is possible, but then you'd be playing what I call pass the parcel, because you're paying 40 times earnings for Microsoft, which, let's face it, cannot grow because it's so big at the sort of rates that Amazon grew at in the year 2000. NVIDIA, because it's so big, can't grow at double every year, because otherwise, first of all, the world, every square inch of the world, including this building, will probably be taken up by data centers. We don't have enough electricity to support those, and it could just be that this AI has reached peak height. But I don't want to go into the stock market on the basis that maybe there's another couple of years left in these stocks, because maybe there's not. Mm-hmm. But there's plenty of stuff that we can buy now where I feel a lot safer, where you might make 10, 20, 30% a year, which, let's face it, for most of us who are trying to feather our nest for retirement or pay for education or whatever it is, that's enough. If you compound at that rate, you're doing extremely well. So don't try and shoot for the moon with some of this overhyped stuff, but get a balanced portfolio together, which may have a few moonshots in it, but the bulk of your portfolio should be in safer, more stable companies.
So just again, one more scene setter, and we'll get more into the slides. Use the S&P 500 as an example. Are you waiting for a 10 to 20% pullback to be interested, or you're alluding to a crash that could be a 50% pullback for the headline US indices?
I don't really know, and none of us know, obviously, what the extent of a pullback would be when the US market breaks, but there are lots of negatives on the horizon for the United States. One is that inflation is more persistent there than it is in Europe or indeed in the United Kingdom, and the fiscal situation is out of control. If there is a loss of confidence in the US dollar, which is entirely possible, and you're seeing some evidence of that in the periphery. So, for instance, you're seeing gold prices going to brand new highs in every single currency. I think you'll see silver prices rocket because it's got a greater volatility than gold in the next few months. And you're also seeing Bitcoin having another resurgence. All of that is probably anti-US dollar stuff. And so if we see a loss of confidence in the US dollar, we see, I'm very interested in what you have to say about politics, the political stuff that's upcoming in the United States destabilizing foreign investors from going in. And you see the Chinese saying, oh, we're not buying any more of your bonds. And they have been large-scale buyers of US bonds in the past, as everyone knows, and the Japanese for that matter. You could just see the turn in the US. And by the way, the Fed is going to keep interest rates higher for longer, and money supply in the United States and the velocity of money is falling. None of that makes for a combination of a continuation in this sort of chart on the upside, but rather on the downside when you're skidding down Mount Everest and your ski suit is being ripped off you as you go down.
So let's jump. I know you've got slides in between this, but why don't we go to the debt to GDP US slide that you've got, and we'll come back again. So
here we are.
This puts in context what you're talking about, and a lot of people here get quite depressed because debt to GDP. This is total debt. I think you're looking at government debt to
just government debt
is sort of a bit lower than that, but we're talking about 100% debt to GDP in the UK. Below what it is in the US, and everyone sort of thinks how terrible it is here. But the scale with which it's due to rise is what you're most worried about.
Yeah, absolutely. This is actually government debt, but it's forecast out to 2020 something or other. So it is inexorable. You know, there's always a threat from Congress that they're going to stop the government from having an expanded debt. But at the last minute, there is an inevitable cave-in because the US government is such a big part of the economy, and the US is now quite addicted to ever-increasing amounts of debt, not just at the government level, but also with share buybacks at corporate level and, of course, at the personal level. This year, you know these figures as well as I do, for the first time ever, the US percentage of GDP going to servicing debt will go above a rate that it's never exceeded before, which is 2%, which is bigger than the some of the key budget items in the US budget. This year, the US will refinance $8 trillion of debt, and put that in the context of the US economy, it's something like a third of the whole US economy, and it will add $2 trillion of new debt. So every single year, the US is adding 10% to its debt burden. And that is accelerating because that debt has to be serviced. They have to pay the interest by printing more debt. It's not a combination that lends me to be positive about the US, either in economic terms by the end of this year or stock market terms, and certainly not in bond market terms. And although I've been a bear of bonds all the way through the pandemic when interest rates were zero, then we said, okay, bonds are a buy again. Now I would be thinking about bonds as being either short duration bonds, particularly in the United States, although you can get better yields elsewhere and better currencies elsewhere. And I would be thinking that US bond yields could go somewhat higher, but they will stay high. They won't be coming down in a hurry.
So just to give some other statistics that paint a similar picture to what Jim's saying. So the UK debt to GDP, 100%. The US is higher than that, 120%, albeit lower than the likes of Japan. But from 2024 to 2026, the UK only has to refinance 21% of its debt pile. The US is double that at 40%, which is another way of putting it that they're going to have to remortgage to quite an extent over the next couple of years. And my question on that is, what chance, Jim, do you think there is of a bond market collapse, a massive fallout, like we experienced here with the Liz Truss quasi-Kwarteng mini-budget, where suddenly the market says, we don't want to finance you anymore? The US, it's always been assumed that would never happen to because they're the reserve currency of the world. Do you think there's a chance of a major gap up in rates in the US and the long end of the curve?
That's a very, very interesting question. I would say the chance of a banking crisis as a result of US government demands for more debt are more probable because, as you know, the government demands for more debt crowd out the private sector. The US banking system, particularly the regional banks, are in trouble at the moment, and you've probably seen New York City Community Bank as the latest iteration of that. We had lots of other examples of that relatively recently. They are competing against money market funds. Money market funds don't have all the regulatory burden of the banks and the risk of banks because they have to lend out for longer duration. But they have the ability to buy US government debt, and they do buy US government debt and are perceived as safer than putting your money on deposit in a bank. So it's possible that as the US government pays ever higher prices for its debt and demands more and more of the debt pool in the United States be directed towards it, that the banks could end up in much more serious difficulty than they did last year.
So interesting. New York City Bank has obviously had a tough time of late. It's very small. A year ago, almost to the day, Silicon Valley Bank ultimately went bust. So it's still fresh in the memory. My take on the US banks on that front is that it's outside of those smaller individual cases. For the bigger banks, it's an earnings question, not a solvency question. And the biggest US banks are in quite a strong position because they do still keep a lot of deposits from everyday individuals. In that sense, I think the biggest US banks will take share in the coming years rather than face collapse. But I don't know, do you like the US banks as stocks or not? You can't give individual recommendations.
I think that they are blah investments. I think the UK banks, the domestic banks and HSBC, which is part domestic and part Asia focused, are more interesting. They might have much higher dividend yields. They have a pretty strong capital return plan, and they're much cheaper. They don't share the extremely good management, for instance, that JP Morgan has. And unfortunately, apart from HSBC, which I think is well managed, the Lloydses of this world are very poorly managed. Mm-hmm. But they're cheap. And you can get a 7% dividend yield on Lloyds, and you'll probably make 30-40% of your capital gain on Lloyds as well, which is not a bad way of going. But JP Morgan, it's expensive. It's a very well managed bank. I agree with you that those big banks probably won't find themselves in trouble. The regional banks have been losing market share to the big banks for decades, right? So, and they will continue to do so.
Yeah, there's still 4,000 FDIC insured banks in the US. Extraordinary long tail of small local banks that I think, again, is an opportunity for the biggest banks to slowly take that market share as those smaller banks can't compete. So it's interesting you mentioned HSBC there, and you've mentioned NVIDIA too, because in another snapshot of the extraordinary size difference between the UK and the US companies, they both reported on the same day about 2 weeks ago. NVIDIA's move that day was worth 2 entire market caps of HSBC, which is the biggest company in the UK, kind of a great snapshot of the crazy differences. Why don't we go back a slide, because we skipped through a topic that you've already mentioned on. So talk us through the scale of why, because the passive versus active argument has been out there for the last 5 to 10 years with a lot of people saying this is why this is the year for active management, and this is why this is the year for picking low PE stocks, but it hasn't played out yet.
No.
Is this a tipping point we're now at?
I think it's the acceleration of concentration risk that these passive investments represent. And the fact that they've gone, as you can see on this chart, relatively recently, 30 years ago, from a small fractional share of the overall savings market through funds. And by the way, the funds market in the US is huge compared to the funds market here, as we know, to slightly bigger share. As I said, they buy more and more of the same names. Those names go up. And then one day the music stops. Now the point is, when does that music stop? I would suggest it's going to stop between now and the next Master Investor Show. So I hope that all of you will take heed of that, because it could go on for another 2 years, but I don't care. We're much safer in the bunker with solid investments than playing past the parcel.
And by solid investments, you mean a company that you're certain won't go bust over five years, so it doesn't matter what happens to the share price in the meantime, or what? What do you mean by that?
Well, that's another great question. I mean, let's talk about HSBC, for instance. I think that the China risk has made it a more discounted stock than it otherwise would be, because obviously it's got a lot of exposure to Hong Kong, Singapore, China. But it has huge international breadth. It's got a cadre of good management. And it's selling with a 6 to 7% dividend yield. It will return on top of that substantial amounts of money by share buybacks over the next few years out of cash flow. Its impairment risk is relatively small, even in China, and it's the world's #1 trade bank, which is a lovely position to be in. If you buy that, I think, like with Lloyd's, you can make 30 or 40% of your money in the next 1 or 2 years with relatively low risk. And you get a dividend in the meantime. Personally, I prefer HSBC to Lloyd's, but if you want a domestic angle for the UK, buy Lloyd's. The other area that's really worth looking at, of course, is investment trusts here in the UK. The UK market is cheap. It is the cheapest of all major international markets. I think we've got a... Should I put that slide up?
Yeah.
Yeah. We're having to flick through a few of these. I had a comparison of major indices. The FTSE is right at the bottom. The next one up is Shanghai, and the one above that is the Nikkei. So those are the cheap markets in the world. But the UK is so cheap, about 10 times earnings, with some pretty good companies, that it's almost compelling. And what's going to happen is that more and more foreign buyers or even domestic buyers with cash are going to come in and take out the companies in the FTSE. And we can see that now with Wincanton in the last week and a couple of other examples.
Currys as well.
Currys another example. There'll be much more of that. Even in our financial services companies, people will be coming in and buying them for their cash flows. The private equity firms, people with deep pockets here in the UK, consolidation and so forth. This is absolutely the cheapest market in the world. And you're mad if you're based in the UK, you pay your bills in pounds. The pound is a fairly solid currency. It doesn't really matter what's going to happen to the politics over the next, in investment terms, over the next year or two. By the UK, and you're supported by the fact that there are so many international investors who are now looking at it and who are going to come in and pick off companies one by one. If I might just very briefly mention one other company. Prudential used to be a UK-focused insurance company. Everyone knows the man from the Pru and all that sort of stuff. They got rid of their US operation. They are largely focused on Hong Kong, Singapore, and China. They're extremely cheap because of the China interests, and of course, there is a huge increase in savings going on in Hong Kong, Singapore, and China, and Prudential, along with AIG, is the main beneficiary of that. So you're buying into a really solid company, excellent balance sheet, good dividend accretion at a low price because of this perceived China risk.
What PE dividend yield is it, roughly?
PE is less than 10, maybe 8 dividend yield. I think you've got 3.5% to 4%. The dividend yield is not as high as in other stocks because they need their capital to grow the business.
So the thing I think is really worth just re-highlighting and stating the obvious with this chart is a lot of people have argued that the valuation discount is US premium, rest of the world cheaper. And what's happened in the last 2 or 3 years is, whilst that's true, the UK, as you're pointing out, has taken an extra leg lower. So my question to you is, why and when will it close again? Because this has persisted for longer than any of us would have expected. It expanded after 2016, the valuation discount, because of Brexit. There has since been some Brexit resolution. So why wasn't that a trigger for it to close again? And why are you certain that it will close at some point? Because you could, just to extend that point a little bit, point to when US tech stocks did correct in 2021, early 2022, and we corrected at the same period of time to the similar extent. So that actually, during that massive US correction, where the most expensive stocks were correcting, the valuation multiple gap didn't really close. So I guess the pushback would be, well, these might be cheap, but if the US stock market collapses, won't we fall back in sympathy?
Well, that's possible. I mean, the good girls go down with the bad is the old sort of thing, and if the US catches a cold, the rest of the world does as well. But as I said, there is an underpinning because of the potential takeout by private equity, which is still sitting, despite higher interest rates, on lots of spare money. And the UK is, I'm sure, their #1 target in terms of taking out companies. Also, you're beginning to get more, I think we were talking about this earlier, retail participation in the UK market, which is great, because for the last 10 or 20 years, UK investors have largely directed their attention outside of the UK and have been net sellers of the UK market. And you've got tax advantages here in the UK for savings and investment that are unparalleled around the rest of the world. And the addition, Victor was talking about the Brit ISA, it's not perfect, but at least it's an additional way of saving. Those don't exist in many places around the world, and this is going to be a compelling opportunity for the UK. And the last thing I'd say about the UK is that if you're offshore and you will not pay dividend withholding tax on UK dividends, whereas if you go to the United States, you pay an average of 30%, in Japan you pay quite a lot, in the whole of Europe you're paying dividend withholding tax. This is a major plus point for international investors. And the Brexit thing, well, we know that at the moment the UK is beginning to outrun Europe. I think it's for particular European characteristics because of the mess in Germany and the mess in France and so forth. But we are going to grow faster, as we have done, than Europe for a number of years, in my opinion, maybe for further than that. And part of that is because the terms of trade for our services industry, which is much bigger than our manufacturing industry, are very positive. We're the number 2 service exporter in the world, and service trade since Brexit has grown by 50%, which is why you don't hear about balance of payments crisis and all this sort of stuff. There's plenty of money coming in to the UK to balance the money that's going out.
So a relative attraction there to the UK versus other equities around the world. Let's talk about things that you're actually absolutely attracted to, and even if the US collapses, might rise, something that have negative correlation. So gold, I think, is the first one you want to touch on.
Well, those of you who were here last year may remember that my number 1 choice for your portfolios was gold, and gold has done quite well. I think we're looking at a 25% increase over the last year, but you ain't seen nothing yet, because for years gold has been hovering around the $1,900, $2,000 range, and it's now broken through. And when we know that when asset prices break through, and there are plenty of reasons for people to buy gold other than just speculation, the price can go a lot higher. We haven't seen a lot of speculative impulse in gold yet, but we are going to see that. And we'll also see it in silver. So later on, there's a QR code you can download, recommended ways of getting into gold and to other assets from the Master Investor website if you're interested. I'm very, very bullish on gold and silver, and I would expect you'll have another very good return next year. And one of the key reasons is central bank buying of gold. The Russian catastrophic invasion of Ukraine was terrible in so many ways, and it was quite right that Russian assets, where possible, were frozen, as they have been. So about $300 billion of Russian assets were frozen. But if you're sitting in another somewhat dodgy country, and I'm not going to name any names, you're thinking, well, maybe the US will seize my assets as well if I do something that they don't like. And so the obvious thing to do is to sell the US dollar, sell other currencies, fiat currencies, and buy gold. And that's what's beginning to happen. So central bank buying of gold is an integral part to its future rise and to its performance in the last year.
And on that note, if you look at the stock of US treasuries that both China and Saudi Arabia own, it's falling. It used to be increasing, and it goes back to the point about US debt earlier. There's fewer buyers than there were previously. Another commodity that you want to touch on, uranium?
Yeah, I mean, I've been saying this for years, and I am slogging through writing a book on nuclear fusion, not fission, as Victor said. I can't see any realistic way for us to make money in nuclear fusion in the near term, but I'm still going to write something about it because it orders my thoughts, and it's, I think, interesting for people, especially since the UK is the equal joint leader in the world in nuclear fusion. But that's some way off, maybe 10 or 20 years before there's a demonstrably commercial way forward for that technology. In the meantime, there's only one thing we should be doing to counterbalance the decline in fossil fuels and to counterbalance the intermittency of wind and solar in our grid and the insecurity of supply of gas, for instance. And that one thing is to build more nuclear power. Now, we've been building these French stations, or the French have been building the stations, and they are an absolute disaster. Overrun, technology is being worked out while they're building them. They're way behind time. But I know that the Koreans, KEPCO, have a reactor that we could build 8 of in the next 10 years, which would power something like 25% of the UK economy, let alone households. And we should just be doing that now. And we should be giving Rolls-Royce, which is our national champion, not US companies or European companies or Japanese companies, lots of money to build small modular reactors, which we could lead the world in, which we are leading the world in. We just need some government intervention to help them. It's a great company, and they can do great work for us. So we have nuclear. Now, the reason I like uranium is because the uranium, and there's a ASP Isotopes is back there somewhere, and they can tell you all about uranium enrichment. Uranium is a small component of the total cost of a nuclear power plant. And even if the price doubled or trebled, it would still be a small component. But it's in very short supply because a lot of uranium came from depleted weapons reserves in Russia, Ukraine. That's largely gone. A lot of it comes from dodgy regimes like Kazakhstan, which are close to Russia, and indeed Russia itself. And there just isn't enough uranium out there. And even the uranium miners who've got contracts to provide a supply of uranium to uranium power stations, nuclear power stations in the United States, are having to buy in the spot market at whatever price to make up their contracts. So I think there's nothing that's a one-way street, but I think you can be, if you buy some of these things like Yellow Cake or Geiger Counter, which have direct access to uranium, I don't think you can go wrong, and you're buying at a discount to their asset value.
So let's touch on China quickly, because it sounds like what you said so far that you're maybe not bullish China, but at least not too bearish. Is that fair?
That is right. I mean, if we live in a world where there's a war between the United States and China, forget about all of our investments, maybe apart from our gold to get us on the last boat out of wherever we are. But it's inconceivable to me that we will have such a war, except for one or two circumstances. And in the meantime, China, which has messed up a lot of its economy through central party planning, through an overemphasis on property, and the property market in China is an absolute disaster. It's not the end of the road for China. It is the world's second largest economy. At some point in our lifetimes, it will overtake the United States with 1-point-something billion people, and it's got some great companies. So personally, we've been dipping our toes into Alibaba, which is the Amazon of China, a very well-run company, super cheap. Prudential, I mentioned HSBC, are kind of quasi-exposures to China. There are China ETFs out there, and I think you should have some exposure to China. Now, let's put this in context. The Magnificent Seven, or as Wilf says, the Magnificent Six or Five, their market cap is 4 times the size of all the UK markets put together and is equivalent to the whole market cap of China. So balance your portfolios a bit. Have something in the emerging markets. India is quite expensive. I really like India as a future prospect, but there's a price for everything. But I think now is the time to put a little bit into China.
So what chance do you put on a full China collapse? Clearly not a very high chance based on what you're saying, but we have seen deflation there, which is a very hard thing to shake off, and it's been growing and it's been printing deflation for 3 or 4 months now, if not longer. Is there an argument that when you've been growing, perhaps slightly manufactured as well, at 6-7% and it starts to falling, that it doesn't just steadily go 5, 4, 3, that at some point things start going bust and you tip into recession, which is definitely not priced in? What is the chance of that happening in China? For you, it's 0% or not?
Well, deflation in a way from China is quite positive for their pricing in export markets, and many of their companies are largely export oriented. So it may be that some of the companies will benefit from a deflationary environment domestically. But I would think that the Chinese government is probably running around at the moment trying to work out how they can stimulate the economy in a massive way, a bit like, Draghi, whatever it takes, will save the euro, etc., etc. Now, there is a slide I've got here, if I may put it up, which is the possibility of a Trump victory in the US election. And I don't know if you know that Trump is saying that he's going to impose a 10% tariff on all imported goods into the United States. Tariffs are appalling, right? I think, if you read the 1930s and the way in which the Depression arose, the Smoot-Hawley Tariff Act is probably the leading cause of the absolute disaster that befell particularly the United States. He's also saying he's going to impose a 60% tariff on all manufactured goods, which is the bulk of all goods coming from China into the United States. That is something that we've got to watch, because for those who are students of history, you will know that one of the reasons that Japan attacked Pearl Harbor and then the rest of Southeast Asia in the early 1940s was because the Americans imposed an embargo on exports of oil to Japan, and they had to go elsewhere to get their oil. If China is pushed into a corner and the government is under threat because there is deflation and falling opportunities for young people, many of whom just don't have any jobs, 21% of the youth population in China is unemployed, then it's possible that a la Argentina, trying to reclaim the Malvinas, or the Falkland Islands as we call them here, might trigger a potential takeover of Taiwan, which would be a disaster for all of us.
So interestingly, just quickly on the Trump and then Biden on China, I have a slightly different perspective. I think Trump talked tough,
Yep.
but actually folded. Two crucial moments, once in 2018 and once in 2019, when tariffs were meant to be escalated, and he folded at the last minute, even though the Chinese didn't do what he said he had been demanding. Whereas I think Biden's done the opposite. I think he's acted very tough, moved in particularly on certain chip sector materials, which have been key obviously for the current part of the economic cycle, imposed very strict restrictions there, but is now, particularly in the last 6 to 12 months, a more open, positive dialogue with China. When you see Blinken go over, you see Raimondo, the trade secretary, you see Yellen go over quite a lot, to try and say, look, we can be tough on you, but we don't want to clash. And I guess my point on that is, whether it stays Democrat with a similar kind of slightly softening of what's been a tough 3 years from Biden on China, or flips to Trump, he'll just do what serves him, which is what he did last time around. And that probably means fold as opposed to be super tough. I think the risk for China is more their fundamentals than the US-China relationship.
I totally agree with you, which is why I put the risk of this conflict with Taiwan as being relatively low. I totally agree with you. I think Trump is the dog that barks the loudest, gets the greatest attention. But actually, if you look at his last term, there was nothing from an economic point of view that was particularly negative or destabilizing. And we just may have more of the same in a Trump administration. I want to ask you, because you know a lot more about politics than I do you think Trump's going to win?
I still think that anybody beats Trump. But my confidence in that is definitely diminishing, as all sorts of factors have raised their head to make things harder for Joe Biden, whether the border issue, which is clearly hurts the incumbent, even if the Republicans could have played ball a little bit better than they had done. I think the war in the Middle East doesn't help for turnout of a young vote, not so much the Muslim vote, which is smaller, but the young vote, in the same way that it might affect the election here a little bit. And the odd thing is the economy. I think, as we've been discussing, in years ahead, it might be revealed that the economy's only been strong because of a huge fiscal stimulus, which I think is probably the case. But things haven't unraveled yet, and frankly, their GDP performance is the envy of the world, and yet he doesn't really score that many points for that. I think the other admitted negative for Biden is that he was the perfect candidate, handpicked by the Democratic establishment to face Donald Trump in 2020. The Democrats had the memory of losing, which they didn't expect, Pennsylvania, Wisconsin, and Michigan in 2016 when Hillary lost those to Trump, and they were focused on winning those back, and he was the ideal person to win those back, and sort of similar appeals to similar types of voters as Trump had in those states. He's perhaps now the worst possible candidate. And again, his age comes into that, obviously. Last time round, everyone knew he was old, but was thinking, well, we'll get to have the types of people that he'd appoint. Janet Yellen, Secretary Blinken, hugely credible, experienced people in that position. Whereas now the focus really is on him personally, because the extra 4 years of aging has come to the fore. And again, you'd probably say they're looking then at Kamala as the potential candidate, in a way that last time she was a a bolt-on to get an extra 10 to 15% of the electorate to turn out. So all of those factors obviously would point to the fact that Trump could win. I think there's something that doesn't come up in the polls, though, that, again, when British people talk about the election, I think they think, oh, Trump, there was all this baggage that started in 2016 and runs up to today. The biggest part of the baggage, and I'm not talking about the court cases, I'm not even talking about January the 6th, the biggest part of the baggage was after the last election, which he already lost to the same candidate. And that's the election denial. And I think that turns a lot of people off who were willing to hold their nose either in 2016, hold it even tighter in 2020 and vote for him, which is you're just pretending you didn't lose. And that could be 5% of the electorate, could be 10%, but I think that's a big enough amount that I don't think go back to him no matter what. The turnout of his base will be total, but that's not enough. I mean, interesting, if you look at the polls now and everyone says, oh, Biden's trailing Trump, they're on like 42, 43. There's still quite a lot to fight for there, and I don't think he'll get many swing voters.
What about the UK election?
UK election, in terms of outcome, there's not, clearly the polls are very, very clear. I think the interesting thing to debate there at the moment is when the election will be. And my view is slightly different from everyone's base case, which I think is nailed on that they think it's later in the year. I think that understandably is most people's base case and probably just about mine. I think the chances of them going sooner are a bit higher than what people are talking about. I think the obvious argument for waiting is, does a miracle arise that changes the polls? And if you're the incumbent, you might want to wait just in case that miracle arises. A sort of selfish motivation that will be in Rishi Sunak's mind, I'm sure. There's another selfish motivation that I don't think is talked about enough, which is allow the local elections to play out in May, get obliterated, and might you get ousted a different way, which is by your own party as opposed to waiting for the general election. And I think he'll be thinking about that just as much as the fact that the prospects in a general election right now aren't that attractive for him. Of course, Theresa May just announced she's standing down as an MP recently. That's exactly what happened to her. She had European elections that solidified in a way that polls and by-elections don't quite do, that her party was so far behind, and that ultimately started the ousting that led to Boris Johnson coming. So I think that's a factor that's a bit overlooked. The other thing in just the last couple of days that we've had is that after the budget, everyone sort of seemingly framed it as there wasn't a rabbit out of the hat, so they're not thinking politically, and they're not preparing the ground for an election. I disagree with that. I think abolishing the non-dom tax status was a overtly political move. And yes, it had been leaked and talked about a bit the week before, but I still think you can frame something as a political rabbit out of the hat if we didn't know about it 2 weeks before. And if we'd told us 2 weeks before they were going to do that, everyone would have said, wow, that's a real political move. So just because it had been leaked 3 or 4 days beforehand, I don't think removes the surprise that they did it overall. So I still think the base case is later in the year, but I think May's possible.
Okay, that's great. Yeah, I've never been a non-dom. I'm not a non-dom. I suppose I can't be one now. But I have to say that the parties, both of them, suggest that the removal of the non-dom status could pay for the whole welfare state, which is obviously not the case. It's absolutely ridiculous. It's a trivial amount in the context of the whole economy. So I think we're way over
nearly
time,
out of time, yeah.
But I'm putting up the QR code for everyone to scan if they want, which takes you to Master Investor and the slides. I personally want to thank Wilf very much. He's turned out on a Saturday. He's a relatively new dad, and he's a very good friend to Master Investor and to myself. And it's really appreciated that you took the time to have this conversation today.
Well, no, it's really my pleasure, and it's always a privilege to catch up with Jim, but particularly on these topics, and I'm sure everyone here as well has enjoyed stealing all your best ideas.
Well, I think there's a combination of good ideas between us, and thank you very much, everyone, for coming in. And now there's a lunch break, I guess, so yeah, see you afterwards.
Thanks, Jim.
Yeah.